Yeah, I think that's right. And, I think it's an important sort of signpost, as I like to call them, along the way of, we've gone from traditional finance saying it's, whatever, rat poison and whatever they want to
Yeah.
call it, a Ponzi, what have you. Now it's part of the debasement trade. I think that's a huge step.
Yeah.
I don't think it's far enough because I think ultimately where we are, there's no debasement trade. This is a debasement trend. We are into fiscal dominance. The Fed is running its first quasi-fiscal deficit, which is just a fancy way of saying operating loss, in its 110-year history. Once Brazil started running quasi-fiscal deficits, once Argentina started running quasi-fiscal deficits, gold and Bitcoin went from sell the rip, debasement trades, to buy the dips, debasement trends. And
Right.
I think that's sort of where we are, where there's still this view is like, okay, well, I'm gonna have to get out and at some point and sell Bitcoin, sell gold for dollars, and yeah, for a trade, sure, but like, really, you want to sell gold and Bitcoin for dollars as we're talking like into this
Yeah.
setup? Like, why?
Yeah.
Like, it makes no sense to me. And so I think
Yeah.
that's still on the come. People will come to that.
Financial repression is inevitable, but even as it drives markets higher, Bitcoin lags while gold captures the spotlight. Luke Gromen frames the moment as one defined by unavoidable financial repression, where policymakers are trying to maintain the illusion that growth alone can resolve the debt load without eroding bondholders. He argues that the math simply doesn't allow that outcome, and the longer authorities try to boil the frog slowly, the more instability appears across asset markets. In his view, this environment favors hard assets gold, Bitcoin, and certain types of real estate as well as skilled labor, particularly in technical and engineering fields. Luke Gromen also explains why Bitcoin may look sluggish despite a macro backdrop that should, in theory, support it. Short-term traders still treat it as a high-beta NASDAQ asset, and concerns around tech leadership, AI competition with China, and the capital intensity of the sector have kept the NASDAQ rangebound. Layered on top of that is the psychological weight of Bitcoin's 4-year cycle, making many hesitant to believe it can behave differently this time. Until he sees broader recognition of that reality, he remains bullish on Bitcoin's long-term trajectory. Mark Moss highlights the dilemma policymakers face. Financial repression is the only path anyone is willing to tolerate, yet this approach has created an environment where most major assets sit near all-time highs. Despite that backdrop, Bitcoin hasn't reacted the way many expected, lagging even as conditions should, in theory, favor hard, scarce assets. Gold has taken the spotlight instead, capturing the flows and confidence that some believed would move into Bitcoin, revealing how investor psychology, cycle timing, and short-term market correlations can temporarily overshadow longer-term fundamentals. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Yeah, I mean, it's ultimately about significant financial repression. Right now, we're sort of still in this bargaining phase of grief about it, that, we can grow our way out of it and we can work really hard and we don't need to crush bondholders, the real value of their bonds. And that's just a lie. Mathematically, it's impossible. So, but the challenge is like the second they say that, the bond market's going to revolt. And so they sort of need to try to boil the frog slowly while also moving more quickly because, China's moving faster and the debt continues growing and AI is accelerating, putting more pressure on it. It is an unenviable situation in which they find themselves. And ultimately, I think it's, we started to see more volatility in certainly gold markets, other markets in recent weeks. I think it's a much more higher volatility sort of baseline. And I think it's ultimately, it's really good for stocks. It's really good for inflation. It's really good for gold. It's really good for Bitcoin. It's probably continue to be good for certainly certain types of real estate, hard assets. And I think it'll be good for wage earners, but I'm not sure it'll be good for sort of white collar. I think might see a reversal of what we saw from 2001, from 1982 to 2020. I think the next 40 years might be really good on a relative basis, certainly for wage earners, skilled trades, engineers, etc. Even if they're prompt engineers as it relates to, to Chat GPT and AIs, but running it hot, and repressing bonds is the only way out.
So it seems like that is the only option that they have, at least the only option that anybody's going to stomach or bear. But at the same time, it seems like, well, you mentioned that when we started that assets are basically at all-time highs. It seems like Bitcoin hasn't really been responding like most people think it would. Gold's kind of stealing the show. What's your take on that?
I'm of a couple different minds. My base case is that we've seen this pattern where, you know, sort of gold goes and then Bitcoin goes and then gold goes and then Bitcoin goes in the last few years. And I think it's maybe that. I also think part of it is, particularly amongst shorter term traders, Bitcoin is traded with NASDAQ increasingly in the short term. And, you know, the NASDAQ for a number of different reasons has kind of been range bound through much of the summer. And I think there are some there's reasons to be potentially secularly concerned with the NASDAQ or certain high flying parts of it, right? You know, can China win in AI, right? Right now, someone showed me an AI leaderboard the other day, someone in that world, and, you know, they said, hey, for what it's worth, this is based on what are supposed to be objective metrics. You know, top 10 AI platforms, half of them are Chinese, half of them are American, right? So like you're spending hundreds of billions of dollars in capital in this country to build that out. What happens if China does to AI in the NASDAQ what it's done to sort of every other industry in the US that it has attempted to do that to? You know, I suspect some concerns around that, some concerns around the capital intensity, et cetera, are weighing on the NASDAQ. You know, some of the trade war has as well. So I think in the short run, some of what is holding Bitcoin back has just been that, you know, that short-term view that, well, Bitcoin is just NASDAQ, you know, a high beta version of NASDAQ, up or down. And so if NASDAQs are out not ripping, there's no reason for me to get involved in Bitcoin. And, you know, there's something to that. Over time, of course, if you go back 5 years, 10 years, you know, they are still they rhyme, but Bitcoin has crushed NASDAQ, right? So, and I still think that'll be the case. But I think those are kind of, you know, and I guess I would layer on one last one, which is, you know, we're to the end of the 4-year cycle on Bitcoin, right? So, you know, 4 years ago was end of 21. We sort of had that last little blip up into the 60,000 range. And then, you know, 2022 was sort of, you know, kicking the crotch after kicking the crotch for Bitcoin holders. And 2017 into 2018, same thing. 2013, 2014, same thing. So I think there's a lot of people that are very cognizant of that and are skeptical that it's different this time. And I think that's a reasonable, view. So I think sort of the combination of all those three things are probably, you know, drivers to the reason why Bitcoin doesn't seem to be responding. You know, let's see. I'm still seeing, you know, I would feel a lot worse about Bitcoin sort of being range bound if I was seeing people telling me, you know, what I'm saying, which is like, they're going to have to repress this thing so much, you know, and, you know, there's no way they're going to be able to win against China without running this thing super hot. I'm not seeing that. I'm still seeing a lot of bargaining and wishful thinking and sort of, you know, idea machine, as one of my friends calls it, right? It's like, well, we'll just, you know, we're going to mine all our mines. It's like, okay, great. Where are you going to get the turbines? We don't know. Well, the lead time on turbines is 3 years. Okay, well, how about the permitting? Well, we're going to get that. You know, that's normally 4 to 5 years. Oh, well, okay, well, we're going to build a rail yard into those mountains. Great. Where are we getting the steel? Where are we getting the welders? Where are we getting the engineers? Are we going to take them off the AI programs? Or are we going to leave them on the AI program and bring in foreigners that you just close the border on? So there's a lot of, like, the idea how to do it, that part's easy. There's an executional side that is being sort of, you know, smoothed over by Washington and Wall Street that I would sort of summarize as, you know, other than that, how was the play, Mrs. Lincoln, right? Like,
Right.
you know, other than the fact your husband was assassinated at the play, how was it? You know, well,
Great.
that's the whole friggin' thing, right? That's, you
Yeah.
know, if you can't execute and put this order of operations together, you know, so let's see how that plays out when it comes out. And I think it is a win when it comes out that this isn't going to get fixed in a year or 2 or 3 years or 4 years, that this is, hey, we're going to need to do 10 years of really aggressive investing in inflation. You know, look, if Bitcoin's down or doesn't do anything on that, that's probably going to force a rethink on my part and a lot of people's parts. But until I see people telling me that, you know, I remain bullish.
Luke Gromen emphasizes that the growing recognition of Bitcoin and gold as part of the debasement trade marks a significant shift from earlier skepticism, but he stresses that the reality goes further. This is a long-term debasement trend fueled by fiscal dominance and quasi-fiscal deficits, like scenarios seen in Brazil and Argentina. For individual investors, Gromen recommends balancing exposure to gold and Bitcoin based on age and risk tolerance, with younger investors favoring a higher Bitcoin allocation for upside potential, while older investors lean more toward gold and potentially shift some equities into high-grade corporate bonds rather than long-term treasuries. Mark Moss complements this view by highlighting how mainstream institutions, such as J.P. Morgan, are framing gold and Bitcoin as safe havens against currency debasement, signaling broader acceptance beyond speculative narratives. He references When Money Dies to illustrate that moving into these assets is often an escape from failing monetary systems rather than a conventional trade. Moss also points to the pressures from a massive, fixed income market and an aging population reliant on yield, noting innovative approaches like Michael Saylor's use of Bitcoin to generate yield while reducing volatility. Given the inevitability of financial repression, Moss advises investors to carefully consider demographics, time horizons, and portfolio positioning in both traditional and digital assets to navigate the evolving economic landscape effectively. Let's get back to the interview.
Well, to your point about it sort of trading with NASDAQ and looking at it as sort of like the speculative play, I mean, JP Morgan came out a few weeks ago and called it the debasement trade, talking about gold and Bitcoin being as the safe haven from debasement. So rather than sort of people looking at it more speculative, it seems like mainstream or TradFi is coming around to it being more of that safe haven asset.
Yeah, I think that's right. And, I think it's an important sort of signpost, as I like to call them, along the way of, we've gone from traditional finance saying it's, whatever, rat poison and whatever they want to call it, a Ponzi, what have you. Now it's part of the debasement trade. I think that's a huge step. I don't think it's far enough, because I think ultimately where we are, there's no debasement trade. This is a debasement trend. We are into fiscal dominance. The Fed is running its first quasi-fiscal deficit, which is just a fancy way of saying operating loss, in its 110-year history. Once Brazil started running quasi-fiscal deficits, once Argentina started running quasi-fiscal deficits, gold and Bitcoin went from sell the rip, debasement trades, to buy the dips, debasement trends. And I think that's sort of where we are, where there's still this view is like, okay, well, I'm gonna have to get out and at some point and, sell Bitcoin, sell gold for dollars. And yeah, for a trade, sure, but like, really? You want to sell gold and Bitcoin for dollars as we're talking like into this setup? Like, why? Like, it makes no sense to me. And so I think that's still on the come. People will come to that.
I think of the book When Money Dies, and they talk about how people sold all their assets for dollars because they were at all-time highs. And at the end, they burned the money in the fireplace that was worth less than the wood was. And so it's like you escape one system into the next. It's not a trade. It's like you're leaving one to the next. But you mentioned that the only real way out is through financial repression, stealing from bondholders. I think the largest market in the world is fixed income, over 300 trillion, about 145 trillion of that is fixed or securitized tradable fixed income. You have the demographics, so you have this aging population that needs that income. How much have you looked into what Michael Saylor is doing with the preferred, strike, stride, and now specifically stretch, by taking Bitcoin and stripping the volatility off of it and offering that digital credit, that yield off of the digital asset?
I've not looked into it a lot. I should. That kind of thing would make a lot of sense if you can sort of, engineer that into an instrument. That would be very good for Bitcoin demand, obviously, and would help people in that position, right? Where, because you've got retirees who own a disproportionate percentage of those 300 billion or 300 trillion, or whatever, in bonds. And, the other side of that is, here in the U.S. alone, they're the ones owed $120 trillion in Social Security, Medicare, Medicaid, right? So you're making repressing them is making the people who owe the money. And yes, they've paid into it, but they haven't paid in enough for what they're taking out. Otherwise, it wouldn't be blowing up. It's basically a tax increase on the people who are using the goods. The challenge is that, if they have to start selling stocks to pay for that, the stocks de facto back the treasury market through the government receipt and the consumer spending. So that you can't have them sell down stocks to help fund that. You've got to keep all assets up or else the whole thing comes unwound. But yeah, in theory, something like that would help. I just haven't dug into it as much.
Yeah, I mean, we have a big problem, as you said, and they're guaranteed to lose money to be liquidated. And so they're going to have to find an alternative. So anyway, it's worth doing some digging into that. I think it's pretty interesting. So knowing all of this, the inevitability of this, how should people approach this market? Maybe kind of break it down, maybe by age, demographic, or time frame. But like, what should they be paying attention to, and kind of positioning for?
And I would say of the 25% in gold, I would split that with Bitcoin, depending on your age. If you're younger, I would probably, and have more of a tolerance for higher volatility, I would probably have a high, more than half of that in Bitcoin and smaller in gold. And if you're older and closer to retirement and less of a stomach for volatility, I would have that more in gold and less in Bitcoin, maybe just a sliver in Bitcoin, capture and participate some of that upside. And if I was older and closer to retirement, I would probably put, some of the 25% that are in equities and put them into, some portion I would put into high grade corporate bonds. I wouldn't put them in long-term government bonds. I just think I would much rather have, I think at some point in this cycle, you will see high grade U.S. corporate bonds trade through, as they would say, similar tenor government bonds. I'd rather own a Microsoft bond than a U.S. Treasury. They're both going to get paid. I just think I think that's how they're going to trade.
The current financial landscape is increasingly defined by a long-term trend of debasement fueled by fiscal dominance, quasi-fiscal deficits, and structural pressures on government obligations. As traditional markets face constraints from an aging population relying on fixed income and the need to preserve asset values, investors are turning to hard assets like gold and Bitcoin, which are now gaining recognition as safe havens rather than speculative instruments. Successfully navigating this evolving landscape requires careful attention to demographics, risk tolerance, and investment time horizons, balancing exposure across both traditional and digital assets to protect wealth, capture upside potential, and maintain financial resilience amid systemic pressures and ongoing market volatility. How can investors strategically balance exposure to gold, Bitcoin, and traditional assets to protect wealth and generate yield amid long-term financial repression and fiscal pressures? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.